Hi. Let's learn about expansionary fiscal policy, which seeks to boost economic growth and demand. This is a macroeconomic policy that involves both monetary and fiscal measures. An expansionary policy is a macroeconomic policy that aims to boost economic growth. This type of policy can be either monetary or fiscal and is based on the idea that recessions are caused by a lack of aggregate demand. The main goal of expansionary policy is to increase aggregate demand to make up for shortfalls in private demand. This can be achieved through government deficit spending, tax cuts, and increased lending to businesses and consumers. Expansionary fiscal policy can involve increasing government spending and cutting taxes to inject more money into the economy. Expansionary fiscal policy involves increasing or decreasing the money supply to make changes to the economy. This can be done by the government providing money directly to individuals, businesses, or taxpayers, or by taking money away to slow down the economy. Measures can include increased spending on infrastructure projects, social programs, tax cuts, and increased transfer payments. Expansionary monetary policy works by expanding the money supply faster than usual or lowering short-term interest rates. Central banks enact this policy through open market operations, reserve requirements, and setting interest rates. When the money supply is increased or interest rates are lowered, it can stimulate consumer spending and business investment. Expansionary policy is implemented by central banks and government bodies, with measures like changes to tax policies needing approval by the appropriate levels of government. Once approved, the policies are communicated and implemented by entities like the IRS and the Federal Reserve. While expansionary policy is commonly used to manage low-growth periods, it comes with risks such as high inflation or an overheated economy. There are also risks of macroeconomic and microeconomic distortions, and potential issues with corruption and information problems. Expansionary policy can lead to increased availability of credit, higher consumer spending, stimulation of business investment, and increased demand for goods and services. However, it also carries the risk of inflation if the money supply outpaces economic growth. Examples of expansionary policy include the response to the 2008 financial crisis, where central banks lowered interest rates and implemented stimulus spending programs. More recently, expansionary monetary policy was enacted during the COVID-19 pandemic to support consumers and businesses and stimulate economic growth. One major example of expansionary monetary policy is the Federal Reserve's adjustment of the federal funds reserve rate. Lowering the Fed rate can increase the economy by making borrowing money cheaper. Expansionary policy often leads to inflation due to increased consumer demand driving up prices. The Federal Reserve often has to choose between combating unemployment and inflation, as policies to address one may increase the other. In contrast to expansionary policy, the Federal Reserve may enact contractionary policies to slow the economy, make debt more expensive, and reduce the money supply. While these policies can slow inflation, they may also lead to increased unemployment. In summary, expansionary policy is aimed at stimulating economic growth and increasing demand. It includes both fiscal and monetary measures and is intended to prevent or moderate economic downturns and recessions. However, it also comes with significant costs and risks, and can lead to unintentional inflation. Here are 5 key takeaways. 1. Expansionary policy seeks to stimulate an economy by boosting demand through monetary and fiscal stimulus. 2. Expansionary fiscal policy includes issuing stimulus checks or creating tax breaks, while expansionary policy includes lowering the Fed funds rate. 3. Expansionary policy is intended to prevent or moderate economic downturns and recessions. 4. Though popular, expansionary policy can involve significant costs and risks including macroeconomic, microeconomic, and political economy issues. 5. Expansionary policy is directly related to the cause of inflation. Though expansionary policies fight unemployment, it may unintentionally cause higher prices. Hope this would help. Thanks for watching.